The S&P 500 had the worst week since December 2022, but when we do zoom out and just look at the past month, we notice that REITs have had an incredible performance, the majority of them up double digits, the like of Prologis, AMT, as well as Realty Income. Now, there's no surprises here, given that we have mentioned time and time again that once the Fed has finished increasing interest rates, that the ones that will benefit the most over the subsequent quarters will be the real estate investment trusts that will outperform the equity market, as we can clearly see here from the historical data. Now, as we've also mentioned, with rates looking very likely to come down, in fact, traders seeing a 100% faith that we will see this, that does mean that we could see continuation of the increase to REITs. However, one thing that we do want to touch upon today, and we have just released an in-depth dive, so do take a look at that of Realty Income, is that whilst we do get a triple buy rating and a very nice monthly yield of 5.43%, we do notice that when we do put it into the valuation model, our intrinsic value at $65 only currently gives this stock a 10% margin of safety, as we can see a buy up to around $59. Now, couple that with upside of around 7% based on Wall Street's price target of $62, we do believe that in the market right now, there are better alternatives with a larger MOS level as well as larger upside over the next 12 months. So today we are looking at 4 of these REITs that we believe to be a better buy right now in the market than Realty Income. The first one is Alexandria Real Estate Equities. Now, we similarly get a triple buy rating right across all of the analysts. It is trading in the mid to upper end of the 52-week range, with also an attractive yield, 4.4%, and a P to FFO of around 12.5. Now, over the last year, they are down around 6.6%, and over the last 10 years, if you have been a shareholder, you would have underperformed the S&P, up only 51%, and we do note all-time highs do sit there right at the end of 2021 at $223, nearly double the current trading price. We also note on the dividend safety scale, the score is 76, making it safe, and their latest increase over the last 4 years sits at 5%, just above that 4% inflationary rate we target on this channel. And what this means, effectively, their dividend cut does look to be unlikely for ARE. Now, for those that see a recession inbound, in the previous 07-09 Great Recession, they actually cut the dividend. They had negative 6% sales. Now, bear in mind, the S&P was negative 12, so that is above the average, but they did trail the S&P, negative 68, the S&P itself coming in at negative 55. Dividend growth, as we mentioned, nice, just above the 4% we want to see. Over the last 5 years at 6%, again, nice to note. Over the last 20, at a bare minimum, they are increasing that in line with inflation, and they have now been increasing those dividends for the last 13 years. When we talk about these companies and we do our analysis, we always like to have a quick look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. So we have our first undervaluation signal, another undervaluation signal with the forward P to FFO 15.5, much lower than the 5-year average of 25.1, but we do see it near enough in line with the real estate sector of 15. Now, do bear in mind, we don't look at any of those models in isolation, and we will conclude when we get to the valuation part. As always, while we do love to look at the free cash flow for REITs, a lot more volatile, so we focus on the AFFO, the adjusted funds from operation, and below 90% is our ultimate maximum target. Nice to note though, over the last 10 years, well below 90%, 76 in 23, anticipated 68 over the next year. We then take a look at the adjusted funds from operations, similar to free cash flow with other companies, consistent increases over longer term. Pretty much what we get, bar the odd year where it is very inconsistent. Nice to note from 2023's position, it is anticipated to increase very nicely. We then take a look at the sales growth. Now for REITs, 5 to 10%. That is in fact what we get, but a lot better year on year, 11% in the more recent period. And when we look at the adjusted funds from operation growth on a percentage basis, we do notice 2 years that have been negative, but overall it is nice to see some very strong years, 6% in 23, nice to report over the next 12 months, expected to be 10%. We then take a look at the total sales. For those that like to see it numerically, they have nearly quadrupled over the last 10 years. But again, one thing we always have to point out with REITs, they will dilute your position as a shareholder, some much quicker than others. and we do have to say that this is one of those that does increase it at a fairly rapid rate. Main reason they have to do this, well, they don't retain a lot of that internally generated cash flow after paying out a substantial dividend. ROIC as well, one of those metrics we do like to look at. We want to see 10% or more for typical companies. Give us faith management are able to effectively allocate their capital. For REITs, 3 to 5%. Unfortunately, over the last 4 years, it has been fairly low at 2%, something we do want to see at a bare minimum at the 3% level. Margins looking okay as well, around the 25 to 35% basis, has been decreasing, so again, maybe something just to keep an eye on. And finally, the net debt to EBITDA, very important metric, the earnings before interest, tax, depreciation, amortization, because it correlates to dividend safety, balance sheet strength, and below 5.5 is what we want to see. Now remember, these numbers that we are looking at below do show the number of years it would take the company to pay off all of their debt net of cash on hand, and unfortunately has been above that every single year. Nice to note though, over the next 12 months it is expected to come lower, but ideally again we want to see it below this line. Now in terms of the valuation for ARE, our intrinsic value of $142 isn't dissimilar from Wall Street's 143, where they see upside of 20%, a lot more than what we just saw for Realty Income. Now in terms of the intrinsic value, we always like to apply a margin of safety, 10% as a bare minimum. Remember, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to 128, then we keep going till it's near the current trading price. And in today's episode, it isn't at a 20% MOS just yet, sitting somewhere between a 15 to 20% level, as we said, with some nice respectable upside of 20%. And remember, this did get a triple buy rating from all analysts. As we go along though, do give us your thoughts below. Also, just to let you know, we have released our latest articles. If you want access to any of these, you can click on the pinned comment below and you can start reading straight away. Some of these we do talk about a lot of other undervalued opportunities in the market right now. So the next REIT we're focusing on is Rexford Industrial Realty. Now we get a double buy, however this time there is a hold from Quant. It is trading in the mid to lower end of the 52-week range. Nice forward yield of 3.4%, P to FFO just under 21. Now over the last 12 months they are down 14%. Over the last 10 years they would have significantly outperformed the S&P, up 250%. We can see though all-time highs sitting at the beginning of 2022 at just over $80. Now in terms of their dividend safety, well, very safe score of 81, and also a very strong increase to the dividend in February this year of 9.9%. So what essentially a very safe dividend score means is that a dividend cut is highly unlikely. In terms of looking at their dividend growth, well, one of the best that we have seen in this sector, 9.9 this year, 19 over the last 5 years, and 22% on average year on year over the last 10 years. We also note they have been increasing those dividends for the last 10. In terms of dividend yield theory, well, again, we get the double undervaluation signal on the yield as well as the forward P to AFFO, but we do have to point out it does trade at a significant premium to real estate's 15. In terms of looking at the AFFO payout, well, as we said, below 90%, that is what we get every single year for this company, 82% expected over the next 12 months. In terms of the adjusted funds from operation per share as well, pretty much consistent increases and expected to continue over the next 12 as well. In terms of the sales growth, while it does look like it is starting to slow down, still very, very high double digits, 26% in 23, 20% on a trailing 12-month basis. And one of the things I really like about this company is that percentage growth to the AFFO, very strong consistently over the last 10 years, 7% in 23, 10% anticipated over the next 12-month period. In terms of numericals, well, we can see more than 10 times growth on the top line over the last 10 years, but again, one of those that does dilute your position at a very rapid rate year on year. We then look at the ROIC. Whilst it is fairly low at the 3% level, it is the minimum we want to see, and it is nice to note that it has been increasing over the longer term. Hopefully this trend can continue into the future as well. Also very nice to note some operating efficiency with margins improving dramatically over the last 10 years, going from 11% to 37% in 2023. In terms of the net debt to EBITDA as well, also very nice to note, for the majority of the last 10 years, it's been below the 5.5 maximum, 4.06 in 2023, expected to increase to 4.5 over the next 12, but still below the 5.5 level, and we can see why it does get that very safe score. Now remember as well, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through, whether it's for Rexford Industrial or any others. So the intrinsic value at $62 will give a very nice margin of safety. At 10%, a buy at $56, 15% up to $53, and at 20% pretty much around the value it is trading in the market today. So you are looking for REXR a 20% MOS level, with Wall Street, as we saw, a buy rating, their price lower at $56, still a very nice decent 14% upside estimated over the year. The next one we have is Equinix with another double buy. However, Quant do not have a hold, they now have a sell rating, and we can see trading in the mid to lower end of the 52-week range. In terms of the forward yield, well, 2.21%, and in terms of the P to FFO, just under 32. Over the last year, well, it is down around 5%. Over the last 10 years, again, another one that would have significantly outperformed the S&P, up 295%. Also, bear in mind, this would be higher if you reinvest the dividends, and we can see all-time highs in 2024 at around $915. A second one that we have with the very safe score, and always very impressive to see, very nice double-digit increases to the dividend. In terms of the last recession, well, they did in fact have above average growth quite significantly at plus 25%, but they did in fact have a near S&P return negative 56. As we already talked about, not just an impressive dividend increase last year, but on average over the last 5 years, 10% year on year, and we can see 8 years of consecutive increases. In terms of looking at dividend yield theory, well, we also get another double undervaluation signal, 2.21 versus 1.74. The forward P to FFO, whilst it is below the 5-year average, it still does sit significantly higher than real estate's 15. In terms of the AFFO payout ratio, it does sit well below the 90% maximum at 45 in 23. No surprise then why we do get to see those very nice increases to the dividend on a year-on-year basis. In terms of the AFFO as well, nice consistent increases over the longer term and expected to continue, something we have seen from the previous stocks as well. Then we look at the sales growth. Remember, REITs 5 to 10%, pretty much that every single year, which is always great to see, if not a little bit better, 15% in 23. And when we look purely at the AFFO growth percentage format, just over the last 4 years at 9%, over the next 12 months expected the same, so pretty consistent, very nice high single digit increase to that metric. Then we look at the sales growth. Again, numerically, we are talking about these REITs that have been increasing their top line at a very rapid rate, and you could argue that this is the first one that maybe, whilst it does follow the others in diluting your position, it is at a much slower rate. Then when we look at the ROIC, we actually get a trend that we don't like to see with regards to any metric, which is a decreasing trend. 3% in 23 is the smallest we want to see. It is a little bit disappointing though, given that out of the last 10 years, 5 of them have been very strong, around 5 to 7%. In terms of the operating margin as well, another decreasing metric, something to consider whether or not that is something that you are satisfied with. And as always, that is why we do apply a margin of safety in the valuation stage. We then look at the net debt to EBITDA, below 5.5 consistently on a year-on-year basis, probably the best metric that we've seen out of the 3 so far. 3.83 in 23, 3.49 expected over the next 12 months. So again, another easy indication of why this has a very safe dividend score. Now, our intrinsic value of $922 isn't dissimilar from Wall Street's forecast. They see 20% upside, $925. And when we do run it through the MOS indicator, 10% a buy at 829, at 15% 783. Not at the 20% level just yet, so you are sitting somewhere between a nice 15-20% margin of safety, with 20% coming from Wall Street's estimates over the year. And as always, don't forget, let us know your thoughts below. This then takes on to Kite Realty Group, where we get just one buy rating, but a strong buy from Seeking Alpha and a strong buy from Quant. Again, Quant typically either have these as a hold or a sell, so very interesting to note their strong buy, especially for one that is trading towards its 52-week highs. A nice yield as well, 4.16%, and a P to FFO just under 12. Over the last 12 months, well, up around 3.5%. Over the last 10 years, in fact, down around 2%, so a very poor return over the previous years, but as always, past performance is not an indicator of future performance. We do also note the weakest dividend safety score, 60, borderline safe, but an in line with inflationary increase to the dividend in October 23. So what does a 60 score mean? Well, effectively, remember this was reaffirmed just a few months ago, but there is a moderate risk of a dividend cut over a full economic cycle. Also, in the previous recession, they actually cut the dividend. They had negative 22%, so below average, and they massively trailed the S&P, negative 86%. We also note over the last 5 years, they actually had a dividend cut. So over the last 10, that is why you're seeing a 0% increase on average. But we do note it has started to increase those dividends again, and therefore they do have 3 years of consecutive increases. In terms of dividend yield theory, well, again, we do get what you could argue to be reasonable valuation on the dividend yield side. And when we look at the forward P to FFO, it does sit higher than the 5-year rolling of 14.6 and marginally higher real estate's 15p to FFO. When we look at the adjusted funds from operation payout, below 90 and 64 in 22, 68 anticipated over the next 12 months. So again, no worries purely based on that payout ratio. But we do note when looking at the AFFO per share, it has started to decrease. In fact, bottomed in 2020 at 1.24, started to increase, and again, the expectation over the next 12 months is that this is expected to continue in the upwards trajectory. In terms of the sales growth, well, very inconsistent, triple digit in 2022, single digit in 2023, and when we look at the percentage increase, they did go through a terrible time in 2018 to 2020. Whilst they have bounced back in 2022, this did sit at low single digit of 2%. Then we talk about the numericals in terms of the sales. 373 million in 2021. It did have a massive increase to 2022 and a very small increase just in the more recent period. We do also note massive dilution of shares just over the last 10 years. In terms of ROIC as well, between 1 to 3%, remember really 3 is the lower end of what we want to see, so always do factor this in when you are looking at your own due diligence and MOS level. And we can see operating margins, whilst they have bottomed in 2022, we would like to see it back at the levels around the low 20s from 2014 to 2019. Finally, the net debt to EBITDA, it is below 5.5 in 2023, and whilst it is expected to increase over the next 12 months, still lower than the 5.5, and this coupled with that AFFO payout, it does look to be like a dividend is safe in the shorter term, but there are a few things just to bear in mind when considering this as an investment. Well, when we look at our intrinsic value of $27, the MOS that we do get at a 10% does mean a buy at $24.22. Not quite there at the 15% level yet, so sitting somewhere between 10 to 15%. And we do know Wall Street has given this a buy with upside of 14%, but we did see both Quant and Seeking Alpha calling this a strong buy. Now, as always, give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.